Hello, and welcome to a new feature on advanced projections. We're going to be providing a few new videos and comments between our regular monthly detailed reports. So this is one that we call an economic snapshot, which is a macroeconomic update and expectations for the U.S. over the next several quarters. So some of the highlights that we're going to talk about very quickly here in these reports. This particular one is going to cover COVID, which may finally be headed towards the exit, equity market bubbles that certainly are not reflecting the economic realities that we're facing now and that we should be anticipating. There are still several residual pressures on the economy, pressures on corporate earnings, and looming Fed moves. So the COVID fifth wave is nearly over as vaccines and boosters have moved the USA back towards something which we hope resembles herd immunity to what has gone through us so far. This, of course, bars any new variants which might be coming through that are significantly different, such as Delta was different than the previous versions. The recession recovery boom is over. Time to dial back on exuberant growth expectations. We have basically climbed out of the hole that COVID dug in the economy and in the GDP, but it's level ground in front of us. We're not going to be climbing any hills and watching for gigantic GDP gains in the next year and a half. The gains are going to be moderate through the end of this year and muted in the first half of next year. And of course, next year, it's an election year. Now people are going to start wondering what is going to happen in terms of, any congressional control changes and so forth. And that will also tend to dampen any great enthusiasm for, huge economic gains. We currently face severely constrained supplies and supply chains, that are just moving at a snail's pace. I talk to people, they've ordered furniture. It's taking 2 months to get here. It hasn't happened. Paint isn't arriving. All the things that people want to do for routine living have been slowed down significantly. And that slowing means a slowing of the economy in general. We also have the same things going on with building supply materials, basic materials, construction, industrial materials, and so forth. So this big glut of supplies that are sitting in the Pacific Ocean off California, for example, it's a problem that's not going to go away in days or a few weeks. It's going to take months to work through this backlog of supply chain logjam. Now, in terms of the equity markets, this is one of our favorite charts, which is based on the very popular Buffett indicator. And we call this the Buffett market value gap. So here is the S&P 500 in the solid green line over the last 2 decades, from the end of 2001 to nearly the end of 2021. And the S&P is charted against several growth curves. There's 5 growth curves here, which tend to bracket where the market normally trades. You can see this top brown line. That is our boundary between what we consider a warm market in this area and just complete bubble territory anytime you're above that. Well, we had a bubble back in 2000, 2002. We had a bubble just before the Great Recession. What is this? This is just an outrageous overvaluation of equities. this is compared to, the recessionary dip that we had last year. So the GDP is the kind of the baseline that the markets return to. Okay, this dashed green line represents 10% of the GDP, so it basically is scaled to fit within the same chart. But you notice how the S&P 500 dithers around where the GDP is. Well, now there's this gigantic gap. The S&P literally is twice where it should be. This is our nominal growth curve, this solid blue line in the middle, and the market periodically returns to that. Well, we didn't even hit that when the recession of 2020 hit because of the massive federal response that kicked in and threw the markets into overdrive. So we didn't even return to the mean, and then it started going towards the sky. So you have to look for the markets to correct back down in this area someplace. The projected Q3 earnings guidance by sector for the S&P 500, on average, almost half the companies reported negative expectations, negative guidance for the third quarter. Right now, in the Russell 3000, 2/3 of all companies are negative. They're in red territory as far as earnings are concerned. Within the S&P 500, almost 50% of the companies are in negative territory. So, we should not be expecting fantastic forward-looking market results. Now, we have 6 long-term recession indicators, which right now are in this state. Precious metals are still very hot, basically because of prices of rhodium and the platinum group metals. The stock indices, as we just indicated, are extremely overvalued. The yield curve is relatively normal. The Federal Reserve is looking at a stable economic system right now, and they've acknowledged the end of the previous recession finally a couple of months ago. The money supply is growing. It was growing at a record pace earlier in the year, but now it's restored to somewhat normal growth. And also the baskets of leading economic indicators are not showing any trouble right now. Now, those things can change. The leading indicators can change based on consumer expectations and so forth. Now, what we're looking at, a review of, first of all, what we saw in the third quarter, employment growth slowed down. There's been an artificial decline of the unemployment level to below 5% because people in the workforce are dropping out. You're seeing reports of, we have the fewest new claims for unemployment, et cetera, going on. But the new jobs numbers are flattening out. And those new claims are because people are hanging on to the jobs they've got, or if they haven't found a job, they're giving up. So the workforce itself is actually starting to contract. The number of people looking that want to be employed at this point has fallen, and that fell by 500,000 people in the third quarter. Auto sales and new homes are being restricted by, the supply chain issues. So you'll see auto production figures that are down significantly in the third quarter, and that will continue through the fourth quarter. Energy prices are starting to constrain spending as well. We're looking for that to happen over the winter because natural gas prices are going up. Gasoline prices are probably flattening out now as petroleum production starts to pick up. And in the second quarter of next year, warmer weather and finally easing supply constraints are going to start showing some positive benefits. The Fed rhetoric should be changing now because the unemployment level went down below 5%, and we're looking for them to start announcing that their asset purchases are going to be tapered off, and they're going to try to start moving us back towards a normal interest rate environment and eventually start unwinding their balance sheet. That's going to take years, but right now, their directional change is what people should be looking for. So, distilling this out, the economy isn't out of the woods yet. Equities markets are way too far ahead of where they should be. The realities that should be muting expectations are going to set in during the next several quarters. But the light at the end of the tunnel we hope to see is that COVID is going to finally decline to a tolerable level of risk. The last time we saw this was in the middle of summer, where daily fatalities dropped below 400, which is still exorbitant, but seems to be tolerable for people that they're not in a great panic about the medical system and about what they're going to be doing for social activities and restrictions on businesses and schools and so forth. So that's where we see things are at right now. We hope to provide something like this once a month or so. Thanks for listening. Please give this video a thumbs up if you like it, and subscribe to our AP Newsroom YouTube channel. You have the opportunity to get somewhat free access to a full member report via the first link in our description. This is for a trial subscription, which is no strings attached. So that's how you get access to our most recent full member reports. They're long. The audio portions are 25 to 35 minutes, and the reports are several pages long. It goes into these topics in great depth. Please consider joining our free economy monitoring group on Facebook, and the link is there in the description as well. We're happy to have your comments, so leave a comment with any of your thoughts and questions on what we've presented. Thank you very much, and we hope to hear back from as many of you as possible.